Warren Buffett is one of the most impressive investors in the world. He used a very simple but highly effective strategy in order to achieve nearly 20% per year in returns since 1965. Interesting enough that this strategy is very simple, and everyone can use these easy rules for better investment. And you shall know how Buffett's ageless concepts will steer your own investments, and how such simple concepts lead little investments to billions. And do not forget to subscribe to the channel and to ring the bell icon so that you never miss tips like these that will make your success. Warren Buffett applies value investing. This approach involves purchasing cheaper stocks than their actual worth and holding such shares for a long time. He adheres to a blend of patience, discipline, and exceptional insight on how businesses operate. When applied correctly, it is a very effective strategy, not only for small investors, but also large hedge funds. Everyone can apply a few key principles leading to Buffett's success. Now, let's look at the core elements of his strategy. Rule 1. Long-term holding. The 10-minute, 10-year rule. Buffett's first rule is simple. Don't hold a stock for 10 minutes unless you're willing to hold it for 10 years. This principle emphasizes the importance of long-term thinking in investing. Buffett doesn't view stocks as lottery tickets. He sees them as pieces of actual businesses. The key to making wise investments, according to him, is focusing on the company's future, not short-term market movements. Let's think of Buffett with an investment in Coca-Cola. He bought Coca-Cola shares back in 1988 for $1.3 billion. At present, his shares are more than $24 billion, and the annual dividends go to around $770 million. Such growth does not happen overnight. It is rather resultant of holding through the bad and good times of market conditions. Buffett does not care about the daily price movement. He only considers the real value of the businesses he owns. Rule 2. Never lose money. The second rule is, don't forget the first rule. Sounds a little obvious, but reminds one how important it is to lower risk when investing. Buffett advises buying stocks for much less than they are really worth in order to lower the chances of losing money. A good example of Buffett using this principle is the short investment in Taiwan Semiconductor in 2022. When he discovered that he was wrong, he was selling the shares before losing cash, as he had bought the shares at a very low price. Mistakes are going to happen in investing, but the emphasis on valuation by Buffett will help limit the damage when things do not go as planned. Rule 3. Buy below intrinsic value. Buffett's third rule is to buy below the intrinsic value of the company. Intrinsic value simply means the true worth of a business. It is not based on the stock price of today, but on its future cash flows. Buffett calculates this by using a method called discounted cash flow analysis. This implies estimates over how much cash a company will make over the long term, then reducing those cash flows to get a figure for their worth today. Take the example of Buffett's investment in Apple. He had invested in Apple share in 2016 with an estimated value to be about $600 billion and a PE of 12. It was selling very cheap at that time because that company had been perceived to earn much money in the future. Now, Apple has crossed over $3 trillion in value, and its free cash flow has expanded. Rule 4. Stick to what you understand. Many have this idea of Buffett to stay in known businesses. Plainly put, you have to invest in an industry and companies you fully understand. This is not just about knowing what the company does, but also about knowing how well it could do in the long run. Buffett often quotes instances where, if he cannot even guess what a company's future will be in 10 or 20 years, he won't put his money into it. A very clear example is his investment in Wrigley's chewing gum. Buffett believes that the market for chewing gum will not change much, whether or even without new technology or even the growth of the internet. It will stay stable because of this factor, making it a good investment. In return, Buffett stays away from tech stocks he does not understand, such as most internet companies, with their vague future profits. Rule 5. Avoid cigar butt stocks. At early age, Buffett applied the cigar butt strategy that his mentor, Benjamin Graham, advocated. The cigar butt approach actually involves the buying of stocks having extremely low prices from firms performing less satisfactorily so that one can have a free puff before going down in smoke with nothing worthwhile left. Occasionally, this policy returns too little. Nevertheless, toward the end of his life, Buffett eventually realized that it is far better to own exceptional companies even at a fair price one has to pay for them. Buffett began to buy things, from fair businesses at wonderful prices to wonderful businesses at fair prices. This new policy, along with his business partner, Charlie Munger, really made the difference for Berkshire Hathaway to succeed in a big way. The other classic example would be Apple. Rule 6. Be greedy when others are fearful, and be fearful when others are greedy. Buffett is known to capitalize on fears in the market. He believes that the right time to buy is when most people are afraid, and the best time to sell is when most people are eager for more. When a financial crisis attacked the entire world in 2008 and most scared the markets terribly, Buffett began massive investments in Goldman Sachs and Bank of America. These were some very risky investments at the time, but he knew those businesses well, which helped him act when people were running away. That is primarily because this rule comes from the basic belief that stock prices are often driven by feelings rather than reason. At times, he would sit calmly as the market went down and would make brilliant selections of how the businesses had been performing during that time, bought stocks at low prices, and bagged big rewards when the market came back up. Rule 7. Seize golden opportunities. Finally, Buffett warns the reader on taking big opportunities that come his way. He believes one gets only a few great chances in life, and if an investor is prepared, they should be able to act then. It runs throughout the life of Warren Buffett to take advantage of rare chances of buying good companies at good prices. It is just patience, waiting for the right time, and having the courage to invest much when the chance comes up. Buffett invested in Apple because it is an amazing company, but Berkshire Hathaway declined to invest in the tech stock. He, himself, therefore made his analysis and knew the business model of the firm and observed that it is actually a great company with lots of potentials. Till date, it happens to be one of the most remarkable successful investments among the many which Berkshire Hathaway made. Warren Buffett has always based his investment approach on some simple ideas that anyone can follow. Long-term thinking, buying stocks at cheap prices, focusing on what you understand, avoiding forms of risky investment, and using market chances. These ideas helped him amass billions. They can do the same to an ordinary investor. Please subscribe to our channel for further actionable reading on winning strategies and shift your attention to mastering timeless principles. Best regards, till next time, invest wisely.